So let's talk a little bit about our need to use financial institutions. And that is, we have to deal with the banking industry in one way, shape, or form. We are going to, this particular chapter, focus on depository institutions, which means they accept deposits and they give loans. And then there are other institutions that are financial institutions, but they're not banks. So stock brokerage firms, mutual fund companies are not banks, but they do accept deposits. So what choices do we have? Well, there are there's actually three major types of financial institutions. There's four technically, but one of them is changing dramatically. But most of you and I have to deal with are start off with commercial banks. And commercial, the root word of the word commercial is commerce. So a commercial bank was really built around commerce. And when we say commerce, we mean business. Okay. Commerce is about trade. And so commercial banks are really business banks. That's their purpose. That was their original purpose when they were set up. And that continues to be their focus. Businesses are a commercial bank's main customer. That's what so all the businesses get the best rates and they get the best services. Now, you and I can do business with a commercial bank. We can have a checking account and a savings account at a commercial bank. And there are many different commercial banks that you are familiar with. You have Chase is one of the biggest ones. Citibank is another. You got Bank of America. There's a lot of commercial banks. Wells Fargo might still be in the area. And I'm missing a bunch. But these are commercial banks. These are basically business banks, right? That's their best customer. That's their main customer. But they also offer checking accounts, savings accounts, and other services to us as individuals. Now, basically speaking, commercial banks, because they are business-related banks, businesses tend to get the best rates, they get the best services, they get the best products that are offered. You and I can do business with commercial banks, but they're going to fee us to death. Okay, so we have to have a minimum amount of money in a checking account. We have to have a minimum amount of money in a savings account. We have to, we're limited to how many checks we can use every month, or so forth and so on. And if you're over that or under that, they charge you fees. Sometimes they charge you fees anyway. Okay? So it's one of those types of things where we're important to commercial banks, but businesses are more important. And so because we're not as important, they usually give us a bit of a hard time. Now that's a problem. If you want to look at it in this way, it's a problem because you are giving your money to the bank. When you put money in an account in a bank, that is your money. Think about that. You earn that money and you put it into an account, right? So that is your money. So why would a bank, and this is my problem with commercial banks in general, why would a bank make it so difficult for you to get your money out of its bank? Why would a bank make it so difficult for you that they would charge you fees for putting your money into their bank? Why would they do that? Right? Well, because you're not their best customer. Their best customer, commercial banks' best customers are businesses. Businesses don't get that type of treatment, but individual bankers like you and I that have accounts, that's what we get. Okay, a lot more. So commercial banks, again, the most important thing I can tell you about commercial banks is they are business banks. That's their main customer. They do offer accounts like checking and savings accounts to us and a full range of other products. But we're not getting the best deals with commercial banks. Why do people want to use commercial banks? Is oftentimes they're everywhere. So you need to get your money from an ATM or whatnot. They're easy to find. Also, because they are such large banks, they tend to provide a lot of internet or other services that maybe some smaller banks couldn't do in an efficient way. And so they do offer a lot of different online products that a lot of people like. So be it as it is. Again, there are other commercial banks that are simply online commercial banks. They call it internet banks. And so you might see those commercials. Again, those are basically commercial banks, but they're strictly online. They don't have the brick and mortar, which is the buildings that you and I will visit. Okay. Savings and loans, I don't even really count very much anymore because they've morphed since the late 80s into commercial banks. They used to be very regional banks that gave mortgage loans for housing, but Congress deregulated them in the late 80s, and through the 90s and so forth, they've changed to the point where they basically are like commercial banks. But you have your local savings banks. Savings banks are very interesting. Okay, so you have like your Rhinebeck Savings, some of your very small savings banks. Now, your savings banks are basically what we call mutual associations. The depositors basically are the owners of the bank. And so when you and I set up an account at a savings bank, like a Rhinebeck or one of the smaller banks around, we are basically, our deposits are basically giving us an ownership stake in the bank. And because we have an ownership stake in the bank, just like all owners of other institutions, you usually get better deals. And so they do tend to treat you a little bit better. They do tend to give you better rates on loans, better rates on your deposits. And so savings banks are pretty good deals for a lot of us. Again, the problem with a lot of small savings banks is they might not offer as many branches, so there may not be as convenient as a commercial bank. They also may not have the technological advancements to offer us a slew of internet banking measures. Excuse me. And the last type of bank, financial institution, is called a credit union. A credit union is basically a nonprofit bank. It's not for profit, it's member owned, it's a cooperative. And so everything about a credit union is about its members. If you have a deposit, if you open an account at a credit union, you're a member of that particular credit union. And so credit unions are member owned, they're membership based. So anything the members need, the credit union will do its best to make sure that the members are being served with all of that. And because it is a nonprofit organization, don't get fooled. All businesses want to make a profit. But if you're a nonprofit organization, the focus is not on making a profit. It's on making sure that your mission is being completed. And so the mission of a credit union is to make sure that the members are provided appropriate services. So you can open up an account at a credit union, and there's a lot of them, Hudson Valley Credit Union, TEG Credit Union, there's a few of them around here. Basically, because you live in a particular area, you can become a member of a credit union by opening an account. Now, credit unions, like savings banks, because they're member owned and member based, they tend to offer the smaller depositor better deals. So you'll get a higher interest rate on your savings and much less fees that are being charged for you. And so basically speaking, credit unions and savings banks, the smaller ones, tend to be better for individuals like you and me than dealing with a commercial bank. That's not to say that commercial banks don't fit people's needs. They can, and that's fine. But what I'm asking you to do in the first project, the first discussion question on comparing institutions, is to see if you're getting the best deal. Remember, when you open an account at a bank, it's your money. You're giving the bank your money, okay? That savings account is your asset. It's actually the bank's liability. All deposits at banks are liabilities to the banks because they don't own that money. They're borrowing that money from you. How do you know they're borrowing money from you? Because they're giving you interest. Anytime interest is involved is because it's a loan. So when you put money into a bank and the bank gives you interest, it's because you've given the bank a loan. Okay. The money that you've put into the bank is your money. They're giving you interest on that money because you've given them a loan. They're going to take that money and, of course, lend it out, try to make more money. But because you have provided the bank with money, you should get a good deal, in my opinion. The bank should be there to satisfy a lot of your needs and not to take your money, right? Not to fee you to death, okay? With this fee and that fee, and you get a deposit fee, and it's not enough money in the account fee, and I have to go into the bank and breathe fee, and just this, they fee you to death. It's like a big fiesta at the bank. Oh man, he's back with sick jokes. Okay, so that's basically what you have to worry about, right? It's your money. You want to deal with an institution that's going to treat you well. So compare the bank you're using now to two other ones. And it wouldn't be necessarily all that helpful to you if you used a commercial bank like Chase and you compared that to two other commercial banks like Citibank and Bank of America. They're basically going to be the same. What would be very helpful to you is to compare the bank you're using right now to other institutions. So if you have a commercial bank, well, look at the savings bank, look at a credit union, see how different it would be if you were a customer of that institution versus the customer that you are with your, say, commercial bank. And that would be very helpful, I think, to a lot of people to compare, because again, it is your money. You're depositing your money. They shouldn't make it so difficult for you to get your money back, and they shouldn't make it so easy for them to take your money. You're giving them a loan. They shouldn't be taking your money. So those are things that I needed to make sure you understood. There are lots of other places in which people keep their money, but they're not banks. So in order for you to be a bank, you have to accept deposits and you have to make loans. Two things. So you have to do both to be a bank. If you don't do both, you're not a bank. That doesn't mean you're not a financial institution. It just means you're not a bank. And so the rules are different under the law. Banking is much more highly structured and regulated. Other financial institutions have their own rules to live with, but they are not banks. So you can put your money anywhere, right? You can open up a stock brokerage account, mutual fund account, other types of accounts at different places. But for the most part, that it might not be helpful. We all have to start at a basic bank. So the focus here is to make sure you understand that your money has to be managed daily through your bank. Simply keep things invested. Keep it in the savings account. Keep it in the checking account that's giving you interest. You want to make sure you're earning money on your deposits every single night, okay, before you need the cash to use it somewhere else. All banks have insurance. Now, this is important because prior to 1933, 34, around there, a long time ago, I wasn't around. But banks did not have insurance. And so if you had any money in the bank and the bank went out of business, the bank failed, you lost your money. And that was a big part of, if you did any research or remember your history from the Great Depression era, that was one of the problems. A lot of banks had closed, and so people lost all their money. Well, FDR, one of the first things that FDR did as president in 1933 and 34 was he said, look, we're gonna force the banks to have deposit insurance. And so anyone who puts money in the bank will not lose their money. And so if you are, commercial banks and savings banks have FDIC insurance. If you're a credit union, you have NCUA insurance. Same program. It protects depositors. How much will it protect you? Well, you can have up to $250,000 at a bank. And if that bank goes under, you will not lose your money. Okay, the insurance protects your deposit. Okay, so that's important. If you have a joint account, 2 depositors, and so it goes to 500,000, but it's $250,000 per depositor per bank is basically how it goes. So what if you have more than $250,000 in the bank and the bank goes under? Well, the insurance will cover the first $250,000. You could possibly lose something else. Of course, the good news is we have since the 80s, the late 80s, we have a federal government that likes to bail everybody out. And so no one has lost money on any bank failure since the Great Depression. Nobody, zero, regardless how big the deposits are. And so as long as we have a government that bails everything out, you're fine. So again, the checking accounts are important. Everything starts with a savings account. You become a member at a savings bank or a credit union by opening up a savings account. And usually they're minimum, $5, $10 to open up an account. Checking accounts are used to pay bills, okay? And so everyone has bills and everyone should have a checking account. And so you need both a savings account and a checking account as a basic financial base for anything else that comes up in financial planning, such as a credit card, which is going to be chapter 6 and 7. We talk about credit. You need both a savings and a checking account. So if that hasn't been part of your goals, if you only have a savings account and not a checking account, maybe that should be part of your financial goals for the next year. That's important to understand. But a checking account is important. We make deposits. Now, some checking accounts, even at smaller banks, may have some fees associated with it, but almost all of those fees go away with direct deposit. And so once you set up a direct deposit, which means that you have authorized your employer, who pays you weekly, biweekly, whatever, to simply deposit your paycheck into this account. That's it. That's direct deposit. So instead of you getting a check and running to the bank, you have simply authorized your employer to put the money into your account at this bank every pay period. That's it. So you don't have to run around, they do it for you. It's a good deal. If you've been at an employer for a while, you should be getting direct deposit. It's easy, and again, it's no cost to you. So once you open up a checking account, they're going to give you some checks. You can write a check if you want. Most people are using a debit card that's associated with a checking account. So it's a card that's linked directly to your checking account, so you can use it, and it takes money directly from your checking account to pay whatever you're using for. So whether maybe you're at the CVS and you need to buy some medicine, and so you use your debit card. All that does is simply take the money from your checking account and move it to the merchant that you're buying stuff from. In this case, the CVS. Just like if you wrote a check to the CVS, or if you took cash out and used it, works the same way. Checking accounts are known to be basically temporary homes for cash. The reason you have a checking account is because you're going to need it to pay a bill. And so it's only going to be there temporarily until you need it to use for a bill payment. Savings accounts are different. Savings accounts are looked at as what we call a time deposit. Basically, you're going to be keeping a savings account, your money in the savings account for a long time. And thus it's a time deposit. Because it's a time deposit and it's going to be there for a longer time, usually the interest that's offered to open up a savings account tend to be a little bit higher than on a checking account. Though not by too much, as it's noted in your book here. But nonetheless, it's important. It's important. There are many checking accounts that pay interest. There are some checking accounts that do not. You have to know which one to open, depending on, in many cases, it's a fee structure. Okay. But if you have like direct deposit into your checking account, those fees go away, and oftentimes you get paid interest on it as well. So you're going to have to ask the bank a little bit. That's part of your project or first discussion question is, what are they paying? So if you opened up a checking account, what are they paying in the checking account? If you open up a savings account, what's the interest they're paying you? You should always know that it's your money. And you want your money to earn interest every single night. You should definitely know that. Okay. So you should look for checking accounts that pay you interest every day. Okay. So there are different types of checking accounts that are listed here. A now account, a money market deposit account, even money market mutual funds provide checks that you can write, but you need a lot of money usually for the money market accounts to start. Excuse me. Banking is important because everything is done electronically. So the need to have a lot of cash is significantly small. So you're not going to get robbed of the cash. But because we do, rely on the transfer systems, this is important. Debit card is a transfer system. An ATM is a transfer system. Direct deposit is a transfer system. They're all electronic funds. And so you're going to see money go from point A to point B. So for your debit card, it goes from your particular checking account to the merchant's account. In a case of direct deposit for your paycheck, it's going from your employer's account into your checking account when you get paid on payday. That's basically electronic funds in a nutshell, transfer system. Okay, talked a little bit about that already. Maintaining a check. Thankfully, there's not a lot of errors today, unless you start writing checks. Then there could be some errors. But most cases, for example, I use everything online. I can't remember the last time I wrote a check. Everything is done online through electronic banking system, online banking system. Where you can pay all your bills. But when you do get that statement at the end of every month, there's a statement, a bank statement that comes, you want to make sure that you look at it to see if there's anything on it that you didn't do. It's unlikely that it's going to happen, but you should still look through it to make sure you understand that all of those times you use your debit card, you see that. But there might be something weird on there that you don't recognize. So you must report that to the bank very quickly, okay? Usually within 60 days, sometimes it's 30 days. The bank has a responsibility to look into it and report back to you what this was about, etc. But if you fail to report any errors, the bank does not have to take any corrective action. You're basically giving them a free pass. So once you do get that monthly bank statement, just look through it to see if there's anything weird about it. Make sure that you're starting a savings program. Every time you get paid, you can deposit that direct deposit into your checking account. And then you can simply, using the banking system, transfer some of that into your savings account every time. So your book, financial planners are really big on emergency funds. And all we really mean by that is, look, if something terrible were to happen where you lose your income today, could you cover your expenses for the next 6 months, for example? And that's an emergency fund. Okay, so what does that mean? If I lost my job today and I had no income, I would have this savings account with, say, 6 months of money that I can use to pay my rent, to pay my food, to pay for transportation, for other types of things. In other words, an emergency fund is just that. In case of a real emergency, which is often just losing your income, is the most important emergency out there from a financial planning perspective. I have the savings account that I can use to pay my bills while I try to get back on my feet, which is basically get another job. So that's really what the emergency fund thing is about. And most financial planners do suggest 6 to 9 months of expenses, but it depends. Even if you have 3 months of expenses, that's terrific. That's terrific. And of course, you could also use, you can also transfer funds for an investment. Banks do offer mutual funds, among other things. They're in the financial products business, broader than just traditional banking. They sell investments. And so, you could also transfer some money on a regular basis into an investment product at the bank, like a mutual fund. Okay, so the most important thing here for this chapter to understand financially is that when you put money in a bank, you've made a loan, and you're earning interest on that loan, because when they pay you interest, because you made a loan to them. So what you want to make sure is what's the interest rate, and how many times are they paying you interest? Okay, which is what we call compounding. Okay, so let's see, I think there's a chart here that shows, yes, right here. Something called the magic of compound interest. Now, I don't have a magician's hat or anything. I'm just going to show you a little bit about how to read this thing. So let's say they promised you a 3% rate of interest on deposits, which you'll never get today. But let's just say, because it is part of the exhibit in the book, you're getting, they say 3%. Now, 3% is a nominal rate. That means for the year. Okay. So if they're only paying you interest once a year, then you're only getting 3% a year. But what if they actually pay you interest more frequently than 1 year? Well, that's what this means. What if they pay you every 6 months? So what if they give you that 3% interest every 6 months, which is semi-annually? Well, that means you're actually making more than 3%, because that after 6 months, they give you interest. And after another 6 months, they give you more interest. Well, now the interest you made is earning interest. That's compound interest. Okay. Well, let's see if they paid you quarterly. Quarterly means every 3 months. So they promised you 3% per year, but after every 3 months, they're giving you interest. So after 3 months, you got interest. After 6 months, you got more interest. After 9 months, you got more interest. And after the year, you got more interest. Well, every time you get paid interest, now your interest is earning interest. And so if you get paid, if they give you interest every quarter, even if it's a 3% interest rate, because now your interest is earning interest, you're getting more than 3%. We call that the effective rate. The effective rate. What if they pay you every month? Well, so instead of getting paid 3% for the full year, now at the end of every month, they're giving you interest. So at the end of every month, they're providing you with more interest, more interest, more interest. January, February, March, April, May, etc. They're putting interest. Now your interest is earning interest monthly. And so your effective rate, even though it's a 3% loan, you're actually getting more than 3% because now your interest is earning interest every month. The best deal out there is daily. The best deal out there is that they're giving you interest every single day on your deposit with them. This is the way I grew up. I grew up with daily interest. It was wonderful. Today, you're lucky to get just monthly. Okay. So check that monthly rate. Okay. So again, if they're giving you interest on a monthly basis, then you're earning interest every month, and that interest is earning interest every month after they give it to you. And so that's the effective rate. That's the effective rate. And we already went over some of those things. Instead of other interest-paying investments that you can usually get at a bank. The most common one is the top one here, called a certificate of deposit, or a CD. And a CD basically is a savings account that you promise not to touch for a period of time. Usually it's anywhere from 3 to 6 months to 5 or 6 years. And in return for the promise not to touch it, they give you a higher interest rate than if it was a savings account. And that's basically what a CD is, okay? So it is basically a savings account that you promised not to touch, and because you promised it, they're going to give you a higher interest rate. You can also buy debt from the U.S. government at a bank. Now, I will go over this briefly. Savings bonds are were, particularly when I was growing up, were very common gifts. So when someone had a baby, or you would also often give them savings bonds. So a savings bond is basically federal debt. So you know how the government, federally speaking, has a lot of debt. They borrow money from other Americans, mostly, to finance the debt. They do borrow money from around the world, but most of the debt of the United States is owned by other Americans or American institutions, like banks and mutual funds and so on. So when you and I are buying a savings bond, we're actually simply investing, we're letting the government borrow money. And in return for that, we're going to get interest. So there's differences. A Series EE bond is probably the more common one. So you buy and bonds, these series bonds start really cheap. You can buy them you can start at $50 and go up. The wonderful thing about a Series EE bond is a $50 bond will cost you $25 right now. And over a period of time, which is now, I think, about 17 years, you'll get your 50 bucks. So it starts at half value and it goes up to the full value. It pays interest every 6 months and it'll go all the way. And that's basically how savings bonds work. A Series I savings bond is just the opposite. A $50 bond costs $50 and then you're earning interest from there. So it's just a different way of the government borrowing money, but it's still borrowing money and paying interest to you. These are long-term bonds because, again, once you give your money over to the government for these bonds, for this loan, they're going to be taking a period of time, 15 to 20 years, to pay you back. Okay. The interest rates tend to be decent. They pay for a small deposit, like 50 bucks. I mean, they're paying you much more than you would if you kept your money simply at a bank, did nothing for that period of time. That's the thing, though. It's a long period of time. It's a long period of time. And a lot of people just don't have, that long of a period of time to wait to use some of their money. A treasury bill here is the main way the federal government, remember it's a US treasury bill, it's basically the main way the government borrows money for the short term to pay its bills. So again, the United States government has monthly bills to pay. And it only collects taxes on a quarterly basis. Every 3 months, it's collecting taxes. So if you got paid every 3 months, but you had to pay your bills every month, you might need to borrow money to do that until you get paid. And so that's basically what the government does. The United States Treasury bill is simply the United States government borrowing money for the short term to pay its bills every month. You and I get the benefit of being able to invest in that. In other words, to let the government borrow money and from us. This is the main component of a money market fund, is United States Treasury bills. It's the main component. So you can actually be an investor by not buying a treasury bill outright, but actually being in a money market fund, because it does the same thing. Okay, so I'm going to stop the sharing here.